Hello everyone. The previous decade has seen the applications of artificial intelligence a ton into quantitative trading and finance. As we move ahead to the applications where we can automate the stocks, where we can prepare them, and we can use quantitative measures to maximize our own returns as well as for the entire company. This method has already been used by multiple HFTs where they presently use pre-decisive algorithms in order to predict the next upcoming scenario of the market. Here, I propose to you a new novel strategy which involves deep reinforcement learning and ensemble strategy in order to maximize the gains. The presently the market share that this value holds is around 70% in the Chinese markets by volume and around 40% in the US markets. Clearly by shown as by this data taken out by the Nanyang Technological University, Singapore. The main problem available is the lack of financial data as in the proper format that any trader would want for his uh, algorithm training or for his appealing performance. Here it lies the main potential that we believe that we can show you. One, how DRL shows the training data as the test data are different and provides you a different learning rate with which you can gain through your data and work through your data and finally provide with you a final output that gives you a higher return. To show you our work, here we show you a sample candlestick graph that we had prepared during the course of the entire hackathon. To explain to you what it is, the candlestick graph employs the basic strategy in quantitative trading, the RSI and the Bollinger Band strategy, which shows that if the present value minus the minimum value is less than the threshold indicated, is less than the threshold index as indicated by the trader in the first half of the trading day, then it releases a buy signal. Our model senses the upcoming data, the upcoming uh, prediction. It makes the upcoming prediction, and then if it sees that the graph goes higher or if the graph goes lower, it takes the buy signal or the sell signal accordingly. And this model goes on for the entire trading day altogether. There is a collab file which I'll be walking you through that entirely shows how our model predicts, how our model gains, and how our model receives and takes those signals. Firstly, I would like to show you the LSTM approach, the long short-term memory approach in order to finding these data. Here, clearly, as you can see in this graph, the orange line is we trained and tested this model over previous data altogether. The live data altogether feeding is shown later in the video. We trained and tested this model over data over 2023 January, 2023 March, the March 1st. This data is trained over that period, and the blue line shows the entire prediction of our model, of my model, that based on LSTM, long short-term memory loss, uh, based on a concept of recurrent neural networks, sequential neural networks to be very precise. The orange line shows the actual prediction by the actual market graph, and the green line over here shows the upcoming market graph. Clearly, as they did by the RSE error trade-off graphs, we can see that the error in my prediction and the actual prediction on that day on March of 1st, 2023 was only of 13.75%. Now that was a great scale. Now to show you the upcoming day's predictions. Here it lies. The blue line that you see is the prediction of the Apple stock. The Apple stock, as you see over here, yes, these are the opening, closing, highest, lowest, and the volume values, and even the dividends and the splits for the Apple stock. Similarly, the same approach can be taken to a multi-stock portfolio allocation approach by taking it to more further companies like Google, Tesla, Meta, MSNT, HFT, and others. To see into the graph, yep, here it lies. The blue line shows the part that has already been taken into the market, and the orange line shows the prediction for the next day. The blue line ends at 100 and 180 and 177 for day one for the March of 31st, and the orange line shows the prediction for when the market will open for the next day on March of 2nd, 2023. And here, now as we join both of this, now the transition the error trade-off graphs. For that one, we believe we took this one. This entire thing, as you can see, this is the portion that we had predicted, this part and this part. If you can clearly see, both the graphs look like, and it only provides a small trade-off of error trade-off of 13.62%. That was the only amount possible in this LSTM approach. Now, jumping off to the next, the actual deep reinforcement learning approach. Here, here lies our model training. Yes, the deep reinforcement learning actually employed three algorithms in order to check and prepare a comparative study throughout the entire job. We use advanced actor-critic method and policy gradient method, deep deterministic policy gradient, and a proximal policy optimization model. We also believe we could have used TD3 cutoff graphs and that other graph as well. But as of now, we believe we trained on these three models, and the final output, that the final graph that I'm about to show, is based on these three models only as well. Here is the model, the algorithms and their parameters for A to C, proximal policy optimization PPO, DDPG, deep deterministic policy gradient, and the time steps for both. Every model was trained for 10,000 episodes, and even with a dual core GPU worth around 8 cores GPU, the model took around 2.5 hours, around 4 hours actually, to train for batch size of 10,000, each batch size 64, and a learning rate of 0.0005%. Here it is, and here lies the model summary. The entropy loss, FPS, iterations, time elapsed, explain variance, even the learning rate, policy loss, reward, and the value loss. This process goes on for the entire training and for the testing time when we test our data. This is the plot. Now, what exactly, I just want to make one point on how our model works. Our model checks this Sharpe ratio. Omega ratio, Sharpe ratio. This is the one that our model checks. Sharpe ratio, to explain in very financial terms, is the excessive return as produced by a company whole divided by the volatility of that particular stock index. Now, mathematically, that would be the excess return that is produced by a company subtracted with mathematically it would rather be the risk invested in a particular stock subtracted from the excessive return produced by the particular company divided by the entire volatility of the stock. Now this gives the Sharpe ratio, and the Sharpe ratio is considered to be one of the finest index to consider whether you should invest in a stock or you should hold, buy, or sell through it. Through our strategies, the algorithms that we developed, this is our output. Yep, this one exactly. The iteration and the model use and the Sharpe ratio. Clearly, as you can see, the PPO Sharpe ratio and the DDPG Sharpe ratio only on the training data had a positive value on these values. On this, the model used was DDPG, and the Sharpe ratio was tuck, 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 a positive value. Now, a positive Sharpe ratio clearly indicates that the particular model has the minimum possible error variance from the actual graph that actually took on that play on that day, rather than the other ones, which, for instance, over this, the A to C Sharpe ratio for the iteration to the 252 iterations on 4th of April 2022 to 7th of to 6th of July 2022. This provides a Sharpe ratio of minus 0.3, which, as compared to the other iterations over here, was considered to be the worst Sharpe ratio. Here is our variance trade-off graph, the actual graph that actually shows the predicted graph versus the actual graph on that day. I feel I couldn't complete the overlaying the second part of the graph, the actual graph, which was for this present day. While I do have the algorithm and the entire model to predict for the upcoming days, I also had a deployment of this entire sector of this entire thing into one SIG. The deployment SIG is currently still under process. Throughout the 48 hours, we could build a login process and a candlestick as similar to allimtrade.com. Allimtrade.com that provides live data and live feeding. Our model presently provides live data as well as the upcoming predicted data where the user can see, user can pay off for a higher price, and the user can take his according strategies according to that. Even against that, we also have automated our entire task by backtesting. Now backtesting over here, this tiny bit of code, this actually provides you the method that if you're running this entire Google Colab file just once throughout the day, this will automate your taking orders, buying orders, selling orders, and shorting orders. Finally, to an extent where you can maximize the profits by the algorithm itself. This algorithm was tested in the 2020 of ICAIF 2020 paper of FinRL ensemble strategy distribution, where it finally proposed a $200 profit over $2,000 that was submittedly traded, compoundedly invested over the period of one entire week. Finally, I believe I made a bountiful progress in providing for my algorithm, which this stays as the error variance. This stays as the predicted data and the actual data. This is the final graph that I finally beg to propose you. And finally, as we still work on the deployment of this into a portal so that we can complete this into a fully funded startup, I believe this can be a noble strategy in order to bring forward or to advance the cause of AI in finance. Thank you.